All right, so today we want to finish up stocks, US versus non-US stocks, finish up alternatives, and then do tactical. I'm still looking for someone to send me their exam one, question one answer that I can grade in front of the class. You don't have to put your name on it. So if someone has the guts to do that, let me know. I'm going to ask the same thing on the tactical question. I'm going to give you last semester's question. If someone will answer it, let me grade it from the class. It's really quite eye-opening to watch me actually grade a paper. So you see the way I'm thinking, because a lot of students he just wants a really weak, shallow answer. And you can be shocked. That's not what I want. I want a very deep, detailed, intelligent, well-organized answer. But some students study for my exams as if it's a multiple choice exam. And boy, that's a recipe for disaster. You can't study for my exam. You got to actually give me meaty answers that are deep and intense. If I don't get a volunteer, I'll just show you the best answer from last semester. But the reason I don't want to do that is it's going to scare you to death, because one student just really went incredibly deep into it. Why did he do that? It wasn't because he wanted a good grade, because he knew he was going to get an A. He did it because he wanted to know this stuff. He did it because, this is important information that you need to know. So I just warn you, there's usually a few students that are incredibly shocked on the first exams, like, wow, he actually wants us to know stuff. That's so unfair for a professor. All right. So we talked about non-US stocks. We talked about developed, emerging, frontier. I don't have any numbers on frontier markets, but you can see the last several years, international stocks have not done well at all. US has been the place to be, and that may still be true going forward. I'm not sure I'm all that excited about Japan and Europe. I think the US still has some advantages. Jack Bogle, the guy who started Vanguard, he actually tells people, or before he passed away, he was telling people, don't even buy non-US stocks, just buy US stocks. That's pretty radical out there. Vanguard sells a lot of international stock funds. His argument is, if you buy Exxon, if you buy Coca-Cola, you're buying international companies. Coca-Cola, McDonald's, they sell all over the world. You don't need to buy, British Petroleum. You don't need to buy Toyota. Just buy these companies that are already global. You would have been much better off if you'd listened to them, because the U.S. market has been where it needs to be. But back in the 80s, if you didn't have Japan in your portfolio, you would have really underperformed, because Japan was just soaring. Since then, Japan's done horribly. But that is the argument that, you're getting non-US exposure by buying these US companies that are international. That doesn't always help you, because it is missing quite a bit. There are places in the US, especially semiconductors and other places, where the US just doesn't dominate. So you have to be careful on that argument. The key is productivity. You can certainly see the decline in US productivity. So, for the longest time, 2 to 3% productivity is pretty good. Now we're struggling to get 1%. Where do you want to invest in the world? You want to invest where productivity is growing, not where productivity is the highest. You want to be where productivity is changing the most, where it's growing the fastest. Where is that in the world? You'd have to look around the world and see where the numbers are. Obviously, productivity is much higher in China than the United States, as they're still moving a lot of people from the farm into the industrial world. That's going to make you much more productive, no question. But there's a limit how far you can do that. I think the US went from 96% agricultural to 2% agriculture in a few centuries. That's pretty hefty improvement in productivity. And then you give a farmer a Caterpillar tractor, what does their productivity do? When you move from a garden hoe to a Caterpillar tractor, does your productivity go up 5%, 10%? What does it do? It goes up millions of percents. So, capital improvement, those kind of things have huge impact. But China can't keep increasing its productivity 5% a year. At some point, they're going to be just like the US. But you do want to be in those countries with the fastest growing productivity. That may actually be in some countries in Africa, it might be some countries in Latin America, or have much younger workforces, don't quite have the capital allocation they should have, but if the capital comes in and their workforces become more productive, those could be the places to invest. But those are also some countries that have some serious problems. So where to invest around the world is a pretty tough question. Some people say forget that entirely. Don't think about the world as US versus non-US. Think of it as global large cap, global mid cap, global small cap. Forget where you live. Just buy stocks in the world. So that's one argument. There's something called the home country bias. Well, people in Japan have a really high allocation to Japanese stocks. People in Australia have a high allocation to Australian stocks. People in the US have a high allocation to US stocks. They can't all be right. The people in Japan can't be right that they should have a high allocation to Japanese stocks. We in the US can't be right that we should have, everybody can't be right, but there's that bias. And some people say, forget it. Don't even look at the world by country. Just look at all the large companies in the world and invest in them, all the small companies. Another approach I've seen some people say is sometimes some stocks are global, sometimes stocks are local. So in some industries, forget about what country it's in. So I don't really care if you give me Exxon or British Petroleum. They're energy stocks, they're global, they're competing with each other. I don't really care. But if you're talking about like a restaurant, yeah, I care where Panera is, so that makes a difference to me. So yeah, you can certainly, like a retail especially, Costco is really strong in the US, but not so strong overseas. So if you want to do a Costco overseas, then you probably have to buy a company over there that does that type of business. So some do come in a combination. Sometimes country matters, sometimes sector matters. So you make your decisions based on that. But what I've shown you is the most common approach. You have US, and the US you have large, mid, and small cap. And then outside the US, you have developed, emerging, and that's just the way the world is mainly structured right now. If you look at mutual funds, that's just the way they're structured. In fact, let's even do that just to prove my point. So y'all heard of Vanguard. I just mentioned Vanguard, right? Good old Jack Bogle, one of my favorite people in finance. So we go to Vanguard. They'll ask you who you are. I'm a personal investor. What we offer, mutual funds. You all are mutual funds. So let's just look here. They have the S&P 500 index fund. How would you classify that? Is that a stock, a bond, real estate? S&P 500 index fund. It's stock. So what kind of stock is it? US, non-US, large cap, small cap, growth, value? What would you classify that? Large cap. Yeah, they tell you right there. I don't use the word blend. I use the word core. What does core mean? It's got a balance of growth and value stocks. What about a global value fund? First of all, is it growth or value? Value. All right, so that's pretty straightforward. Global. What does global mean? What's the difference between global and international? So if someone wants to sell you a global stock fund and someone else wants to sell you an international stock fund, what's the difference in those two? Anybody know that? What's not in the international fund that's in the global fund? Yeah, US. So the global means it includes the US, international means it doesn't include the US. So that would include US stocks in it. What about this one? Where would you put that? International growth. So I just told you most people US is large cap, small cap, growth, value. But here they're breaking up the international between growth and value. You can do that. Most people don't do that, but international. How much US stocks are in this fund? Probably none, right? Because it's international. Balance. What does the word balance mean? Does it have stocks in it? Does it have bonds in it? Yes, it does. So balance means what? It has multiple asset classes in it, usually stocks and bonds. Here's an intermediate term tax exempt fund. So is that bonds or stocks? Definitely bonds. What kind of bonds? Yeah, definitely US. And it's municipal bonds. So what are they looking for? Tax exempt bonds. Remember DC cuts I, that's the T of DC cuts I. So balanced funds have multiple asset classes in them. And a lot of these firms have started these target funds. When I was at USA, we started target funds. They're real popular. If you're retiring in 2025, then buy the 2025 fund. If you're retiring in 2060, then buy the 2060 fund. I mean, they're fine. I'm not a huge fan of them, but they're okay. So when do y'all retire? You're what, 22, so 40 years. So there's your fund right there, the 2065. What do you think is in the 2065 fund? You think it's 70% bonds, 30% stocks? What would you think? I would go 100%, but I bet they're closer to maybe 90. So let's just see. So 89% stocks, 9% bonds, and then cash, which is, you know, why don't they go 100% stocks? I don't know. I think this is a flaw. If I were you, I'd go 100% stocks. I seriously doubt when the stock market drops 30%, you're going to say, wow, I lost 30%. I could have lost 31%, but I'm sure glad I had that 9% in bond. Boy, that saved me. I don't know anyone who's ever said that. However, in a strong up market, you're definitely going to notice that 9% in bonds is going to be slowing you down. So I don't know why young people won't just put it all in stocks. And then you get down with bond funds, right? Intermediate term. You know, we talked about the three types: short term, intermediate, and long term. Vanguard's supposedly the one that came up with those terms. Let's jump to page 3. International. So that's a stock fund. What do you think this is? Is it US or non-US? What do you think? They don't tell you it's definitely US, right? If it's international or global, they're going to tell you because that's pretty important. So if they just say stock, large cap, well, we talked about bucks, right? BUCS, so capitalization, large cap, and growth. Do you think they have a large cap value fund? I'd be really shocked if they didn't. There it is. What is this one? Mid cap value, right? So you thought I was making all this stuff up, but I'm giving you the conventional approach. Small cap, mid cap value. They probably have a small cap value, small cap growth. They put it all together. So this is the way firms think. This is the way they put them together. What about blend? What does the word blend mean? I say core, so it has some growth, some value in it, but it's mid cap. All right, right now I'm mid cap value and small cap value. So I don't want the core, I want the value. All right, so far that's worked well, but there's a disaster in my case, especially if we have a recession where that's not going to work well. What do you notice about their expense ratios? Really, really low, aren't they? Typical expense ratio is like 1%. Their expense ratio is 0.05%. So they're really, really, really cheap. So that's kind of nice. All right. So you can see, looking at Vanguard, they're using essentially what I talked about. They did have an international value or growth, so they might break up international stocks between large and small. But the traditional approach is US, is large, medium, and small cap, growth and value. And then when you get outside the US, it's usually either developed or emerging. If it says international, you want to ask how much is their international fund developed markets versus emerging markets. If they're only developed, they'll probably call it a developed market fund. If it has both developed and emerging, that's an international fund. But you can see with Vanguard, it's real quick. You just click on the fund, you go over to the portfolio, and it'll tell you exactly what the breakout is. All right. So our goal is to be parsimonious. You remember that from our initial discussion, is how many categories do you need? If 12 is enough to explain most of your risks, then stop at 12. Because you can see that's a lot of work to have to go, you know, you're going to break international between value and growth. So now you got developed value, developed growth, emerging value, emerging growth. That's 4 asset classes instead of 2. You just doubled your workload. If that's not going to really help you, then, and I have to tell you, I don't know anyone that breaks up emerging between growth and value. There's a lot of people that break developed between growth and value. I don't know anyone who breaks emerging. You hope emerging stocks are growing fast. All right, so When you go to non-US stocks, you got a little bit more work. You got to worry about the country's regulatory regimes. You don't want a country that's about to have the government take over every industry. We already talked about the World Bank's ease of doing business index. They also have a corruption index, which I think is really interesting. This book, I'll show you this book here in a little bit. Jim Rogers, good guy. You could probably find him on YouTube. I like people like Jim Rogers and Jack Bogle, really rich people who don't care anymore, so they just speak their minds. And boy, he steps on toes all the time, but I love it. He's a little bit, out there. He gets in trouble every once in a while, but I like it. I love this book, Why Nations Fell: The Origins of Power, Prosperity, and Poverty. If I were trying to be an international investor, these are the kind of books I would read. The purpose of this book is to try to help you understand, why does one country do well and one do poorly? What can you look for? And the book's a little long. It could have cut it about 70%, but they have their theory, and then they want to prove the theory, and they prove the theory with example after example after example. Man, it's just, they go back hundreds of years. Why did Argentina do so well and then fall apart? What were they missing that another country wasn't missing? Because Argentina used to be one of the richest countries in the world. Now it's, having serious problems, and it's been having serious problems for quite some time. They talk about what are those things? Is it because they have commodities, they have access to oil and other things? Is it because they're near a water stream, water source, so they can ship their goods around? Is it their government? Is it some cultural thing? What is it? They go through that, and they have a theory that these are the things that separate the winners from the losers. Well, if I were an investor, I would want to know that. If you don't want to read a long book, then you can do one of the great courses by Daniel Dresner, which is essentially, he summarizes this book in a lecture. One of my students sent me that lecture, and I went through the whole thing, and I said, boy, that sure does sound like this book by these two guys. And sure enough, in his lecture, he acknowledges that that's what he was doing. So if you don't want to go through the entire book, you can watch his lecture. And then there's some podcasts out there. So there's Jim Rogers. His philosophy is Asia's the place to be. So he's betting on Asia. He bets on Asia so much that he got married, had 2 daughters, and they moved to China. And then when he moved to China, I think he was in Beijing. They were having some pollution problems in Beijing. He couldn't take that anymore, so I think they moved to Singapore. His daughters are fluent in Mandarin and in English, and that's what he wanted. He wanted his daughters to be freely working between those three languages and cultures. I think some of you might think about that. Where in the world is the growth going to be? And then move to that country and learn that language and work there. I mean, if you've got the guts to do it. There was a while there where they were saying, not Asia, this century is all about Africa. Africa is going to be the place where all the growth is. Why? Because they have all the resources, and they have all those precious earth kind of things, a lot of oil. They got a young population. But what's the issue? It can be government corruption and those kind of things that they're really struggling with. But it could be the continent takes off. We've been saying that for some time, but it's kind of frustrating if a nation can really get it all together. It could be the growth engine of the future. So here's that great courses book, very similar to this one. I forget how many pages this is, but I thought it was a really good book. And then this podcast, it's a few years old, so 5 years, 6 years old. He does have a book. I read his book. I thought it was pretty good, but he talks about the 4 Ds. And what he's saying, I think, is still true. His 4 Ds, forget what they are. I think it's in here, though. Oh, here it is, down here, if I can get rid of Zoom. Deglobalization. So we say we had all these decades of globalization, now we're going to deglobalize. So who wins in deglobalization, who loses? So he's saying there's a lot of European countries that are going to lose in deglobalization. He says the US may actually do fairly well in deglobalization. Depopulation. We're not having babies anymore. Who wins from that? Who loses from that? Deleveraging. We got a lot of debt out there. What happens in a deleveraging environment when governments have way too much debt and they're paying it down? What happens then? Is that inflationary or is that deflationary? So he talks about that. And then democratization. It amazes me the surveys around the world about Latin America, how they're negative on democracy now. I'm like, well, what are you positive on? If you don't want democracy, what do you want? We want a really, but friendly dictator. So that's kind of scary. But democratization, those are his 4Ds. But he's not just telling his opinion. He's saying, given that, this is where you should invest. Isn't that what you're looking for as an investor? These are the things that matter. Why would the U.S. do better in deglobalization than Germany? And he explains that picture. So you don't have to agree with him, and he at least opens it up. So he has a book. You can read his book, or you can listen to his podcast. You can find it. Barry Ritholtz has a really good podcast. So that's the nice thing about international is you can become a real expert in a particular market, and that could be your entire career. You just learn one market. You need to learn a market that you think is going to be around. So there's a possibility it's going to be taken over, like Venezuela or something. That's not going to be good because that's not going to work. I wouldn't want to be a stock analyst at Venezuela right now. Might not work so well. So you want something that's going to be around. But if you know a culture, there's firms. I thought it was interesting. Barclays actually goes around the world and they just pay people who live in these countries and just checks in with them every once in a while. So I don't know what they pay them, maybe $100 a week. So they'll pay you $100 a week. We're just calling. We want to know what shoes are y'all buying? What bikes do you see on the road? What cars are you seeing around? Where are people eating right now? Would you take that job? Give you $100 a week. Every once in a while, we'll check in with you. Just tell us what you see going on. I mean, why do they do that? They need to know what's going on in the streets to get the real answer of what's going on in these nations. What are people buying? What are their habits? Those kind of things. So there's a lot of room for research on the international side. I'm not an international side person. When I was head of equities, the guy who worked for me, he was from Pakistan. He was our international guy. He knew international markets really well. So he took all that. I took the US stuff, so we kind of broke it up. But there's just so much you can do there. All right, so someone give me DC cuts I. Off your head. D, duration. What are the asset classes? Short-term, intermediate, long-term. Interest rates are falling. What do you do? Lengthen duration. You expect interest rates to fall. If interest rates all are falling, what do you do? Well, it's too late. But you expect rates to fall, then you lengthen duration. Or at the DC, what's the C? Convexity. What are the two asset classes there? Positive or negative convexity. You expect interest rates to become more volatile. What do? High convexity, avoid those negative convex. The next C, credit. You're expecting a recession. Higher quality bonds and probably lengthen duration, right? Because a recession, you expect rates to fall. Then the U, US versus non-US, which gives you the sub-asset classes. And what did I say there? Probably for most people, it's not an asset class. And why is it? Because currencies are going to dominate everything. The T, taxes. So you only have two classes there. Taxable, tax exempt. You plug it into the formula. You see which one has the better tax adjusted yield. The S, structure. So some bonds are structured a little less liquid, complicated. It might give you a little premium. And then the I, inflation. There's only two there, inflation linked and non-inflation linked. You expect inflation, I would not buy inflation linked right now because they have negative yields. But if I were worried about inflation, really worried about it, I might try them. What about bucks from the stocks? Beta, so there's two classes there. Cyclical and defensive, expect a recession. Increase beta or reduce beta? Expected recession, reduce beta, the U. US versus non-US, how many classes there? US, developed, emerging, frontier. There you expect Europe to do better than US, what would you do? Avoid US by developed. On that one, I have to actually tell you. Right? It's kind of straightforward. I expect emerging markets to really sell off this year. What would you do with your emerging market allocation? Not underweighted, right? So pretty obvious. And then what are we left with? S? No, C. Capitalization, how many classes there? Large, medium, small, and then you have micro and expected recession. Probably more large cap than small cap. Get out of stocks entirely, but within stocks, remember you have to say within stocks. So you probably, if you expect a recession, want to reduce your stocks overall, but within the stocks that you keep, you want to go more in large cap than small cap. And then we have S. Style, the two there. Growth and value, expected recession. The surprising answer, expected recession. Remember, value means low quality. Don't forget that, all right? Value stocks are, why are they cheap? They're cheap because something bad happened. You want a low quality company that has something bad happening to them going into a recession. Probably not, right? So growth during a recession, value during strong economic times, right? So y'all got it. See how the exam question is just a matter of knowing all of that stuff. Same thing when we get to the tactical. All right, alternatives. So what are alternatives? Everything else. Why do you buy alternatives? Two reasons. Alternatives are always talked about in terms of diversification. Alternative give you diversification. That means they're not highly correlated to other asset classes. And so that means they're going to reduce the volatility of your portfolio. The second reason, one of the biggest alternatives is real assets, things like real estate, timber, commodities. They tend to give you a pretty good hedge to inflation. Has that worked this year with oil prices? Inflation's up, or would oil have been a good place to be this year? Yeah, it certainly worked this year. What about other commodities? Probably so. You probably would have done okay. So often for real assets, they provide a hedge against inflation. So that's an alternative. Two reasons we buy them, primarily for diversification. I've never seen a presentation of alternatives where they did not show correlations. It's just a big part of what that asset class is. So we're going to break it up between real assets and then other. Other is only going to be private equity because we'll talk about what other things could be other. On the real assets, we're going to break it between real estate, timber, commodities, and then other. All right, so we've got real assets and everything else. And real assets, we have real estate, timber, commodities, and other. All right, do we have real estate finance majors in here? Had a student just ask me, should I switch from finance to real estate finance? And I told her, if you're not sure you want to do real estate, then I would stick with finance. I gave her a name of a former student who has a finance degree who's now killing it in real estate. I told her to call him and see if he wishes he got into real estate finance instead of what he has, but it doesn't seem to be hurting him any. He's setting all kinds of records right now. All right, so a real asset is something you can touch, hold on to. It can be a building, it could be timber, it could be a barrel of oil. So the biggest asset in the world is probably real estate. I don't know between real estate and debt, but real estate might be the biggest asset in the world. It's hard to measure because it's hard to know all of the real estate in the world because there's so much of it that's not that well known. So real estate, what kind of asset class is it? The hardest thing with real estate is figuring out what to assume about it. What is its expected return? What is its risk? What is its correlation? It's really, really tough. And the reason it's so tough, I'm selling my mom's house right now. How much is that house worth? Well, I don't know. When will I figure out how much her house is worth? When someone offers me a price. I had an appraisal The appraisal said plus or minus like $100,000. I said, okay, thanks. That gets me in the ballpark.
You just see what people are selling houses for in the area.
Well, that's what the appraiser did. And she found 3 houses. 2 of them were for 570 and one of them was for 440. And she said they're all comparable.
Then you,
So, but then my agent said, well, that 440 one's really not comparable because of this, this, and this. And then there's a big debate and all that kind of stuff. So, am I that uncertain about the value of Facebook stock? How do you figure out how much Facebook is worth? Just go look it up. Pretty obvious. Why? Because Facebook trades every second of the day throughout the day. So real estate doesn't trade like stocks. So we don't really know the value of real estate until it's sold. You can get an appraisal. The problem with appraisals is they don't move the way stock and bond markets move. Appraisals are smoothed out. So it might be true real estate prices are going like that, but we don't know because there's no price. And the appraisals are probably not going to have their appraisals go like that. They're going to be much smoother. So when we look at the historical valuation of real estate, it looks very low risk and it looks very uncorrelated to everything else. But that's probably because the real estate numbers we're looking at only have a few cells and the rest of it's all this appraisal, which is just a guess. So we struggle with this at USAA because USAA has a large real estate portfolio. I was put in a department where it was kind of interesting. I got a phone call one day and they said, Ron, you're working here now. You know, you can say no, but then you won't work here anywhere else. I mean, essentially, they told me you're working in this department now. And the reason they put me in that department, I was in the investment. They wanted someone from the investment company, someone from the real estate company. And then they also got the equity guy from the investment company. Our boss in the investment company said, get rid of all that real estate and give it to us. We're better off in stocks and bonds. So we already had a little bit of a bias. And then we had the guy from the real estate company, Bruce, he came over. So the 3 of us came over and we were supposed to decide, should USAA have real estate? And we had that bias from my previous boss's boss. Our final conclusion was, yeah, real estate is a really good investment for USAA. And I'm glad we did that because the real estate portfolio is done extremely, extremely well. But that was the big debate. But in order to do that, we had to come up with assumptions. What would be our expected return on real estate? And we finally decided, well, it's somewhere between stocks and bonds. The reason we said that is because its risk is somewhere between stocks and bonds. But then trying to figure out its correlation and its risk is practically impossible. We looked at just the actual numbers we had. Real estate looked like the world's most perfect asset class. Very, very low volatility, very low correlation, everything else. We would have been putting, our models would have put 70, 80% of our portfolio in real estate. We know it's not that good. So we did all kinds of things. Something I highly recommend. I was reading article after article. One thing I learned to do early in my career, if I read an article I really like, I would call the author. And guess how many times I got cussed out for doing that? 0. Guess how many times I had very lengthy conversations for free consulting, almost every single time. One article, I called the guy. He's like, well, I can't believe someone read my article. He was like ecstatic. It's like, not only read it, we're actually doing your article here at USAA. He's like, I can't believe you are doing that. That's incredible. So, I mean, it's the thing to do. People love, they're writing these articles. They actually like that kind of conversation. And some of them actually thought I was an important person. They didn't know I was just a peon analyst. I think I might have told you. Yeah, at one point I had the head of the stats department at Princeton University was calling me on a frequent basis to talk finance. I think he thought I was an officer at USA. I never told him. He would just call me and we were just like, it was wonderful for me. We're talking about all these kind of issues we're having with asset allocation. I thought it was tremendous. He finally just stopped calling. He must have figured out this guy's not going to give me any money for anything we sell, but it's great. So, there's all kinds of free consulting and people write articles on this stuff all the time. Just call them up and it's easier now. I don't even know how I did it back then. Finding phone numbers back then, we didn't have the same access you do, but people will talk to you about that. So it is a big issue. So we read a lot of articles. How do we adjust for this? And we finally come up with some assumptions we thought were reasonable. So appraisal smoothing just means we don't have really good reliable numbers on historical returns for real estate. We just can't trust it. Even the numbers we have are only quarterly, they're not even monthly. And we know most appraisals are really focused in on the fourth quarter. So the fourth quarter tends to be more volatile because the appraisers are a little more strict that last quarter. People want to get really good numbers. So there's all kinds of problems with real estate numbers. And then within real estate, you can break it up. We tend to break it up in two ways, either property type or geography. So property type, things like hotel, office, retail, industrial, apartments, malls. I don't know if malls is one anymore. When's the last time y'all went to a mall? That's something, any of y'all go to malls anymore? I don't know the last time we went to a mall. That was what we did when we were kids, but no one does that anymore. Malls are really struggling right now. Industrial has been wonderful because of the internet. A lot of these firms like Amazon are building these massive industrial parks. What has Airbnb done to hotels? So far, it looks like it hasn't really hurt them all that much, but hotels seem to be doing really, really well. How about office? Is this the time to be doing office? Is work from home going to destroy this market? So let me check the time. Sorry. 4:37. All right, good. I can go by that. All right. So office might be a little dangerous. I'm trying to get one of our alums. He does commercial real estate in New York, and I'm going to try to get him to talk to Investment Society with that very question. What has COVID and work from home done to commercial real estate in New York City, which is obviously a really big market? I think they're actually doing fairly well, but I'd be curious is you retail, that was one people said was going to go completely out of business. Do you still go to stores? Do you think there'd be a time where you don't go to the grocery store at all? Is it possible? I mean, we're doing things today we would have never thought we would have done 20 years ago. You think it's possible you will never go to the grocery store again and all be some manufacturing plant on the corner and they drone it over to you, or some robot comes over to your house? It's possible, right? I mean, would you rather go to the store or have it delivered to your house? Do you want to go to the store? I wish HEB had a program where, because everything I buy is at HEB, they know everything I buy. I wish they would put that into a database and tell me what I bought and then just reorder it for me. And I wish they would just send me my receipts and say, based on your historical shopping, this is what you need this week. And I can go through and edit it and send it to them. That shows them. I would do that. That would be kind of nice, right? I don't like HEBs online because they don't have the stuff I buy, but if they know what I buy, they can go get it for me, right? Have some robot do it. That would be a great service. We're probably not that far away from that. Our artificial intelligence is getting to the point where it could probably do all that for us. So who knows what's going to happen with retail? And why is the mall across the street doing so well, where Ingram and all the others are doing so badly? What is it about that mall across the street that's so good? I bet more of y'all been to that mall than the Ingram Mall, or to. Does it make a difference that it's outside? What is it about that mall that's doing so well? So real estate is an interesting field. A lot that you can do with. If you're looking at geography, from the U.S., we tend to talk about the Northeast, the Northwest, the South, the midsection of the country. That can have a noticeable impact. International real estate can be a big thing. So that's the way we tend to think about it. NCREIF is a good site. They don't provide. Yeah, did I spell it right? NCREIF. So close. It's what? .org. And one thing about real estate is they love photos. One thing I noticed with USC real estate, there's pictures everywhere. The CEO likes to be in a picture of himself in front of a massive building. It's kind of cool. Stock people, we don't have that. We don't go around with pictures of our stock certificates. So they love showing buildings. What city is that? Boy, that should be pretty obvious. Is that New York or Chicago? They used to provide data for free. They don't anymore. So you used to be able to get historical real estate returns off their site. The last time I checked, it was only for members. Maybe they've changed that back. They have a non-member data subscriber. I should try that and see. So they used to provide information. They do have a timberland. We're going to talk about timberland. So, you know, there's some good sources out there that provide, you know, they even have education webinars. So there's some things you can teach yourself. But NAREIT, there's sources out there that have a lot of information, and they have an incentive. I don't know why they've stopped making their stuff free, because they have an incentive for you to buy real estate, and they should provide all that for free so that you buy what they're selling. But it's getting harder to get data. So you might say, I don't want to do real estate because that's tough, right? You're going to buy a building, and it's, you know, $400 million building or $100 million building. It's very liquid. Is there a way we can use the stock market to get real estate? And someone said, you know what, I got a good idea. Why don't we have companies that own real estate, but instead of you having to go and buy the real estate from them, instead, let's just stick all the real estate into a stock, and we'll just convert that illiquid real estate. They wouldn't have good prices for, we don't have good appraisals for, and let's stick that in a stock, and now we have a price every second. And they created something, have you heard of this before? Real Estate Investment Trust, a REIT, created by the tax law. They're tax-free. They don't pay any corporate income tax. As long as they pay a certain amount of their money out as dividends, they don't pay any income tax. That's the reason they have really high dividend yields. And so people say, you know what? I don't have to buy real estate. I'll just buy REITs. And then I go get REITs and I can get my return and correlation answers. Well, anytime you try to make something that's illiquid and try to make it liquid, you actually radically change the asset. It's no longer real estate. So real estate investment trusts look like small company stocks. They don't look like real estate. They don't act like real estate. So they really look like small. Why? Because most real estate investment trusts are small companies. So if you buy REITs, you're essentially just making a huge allocation to a particular type of small cap stock. You're really not buying real estate. You're going to be really disappointed. There was a mutual fund, I inherited it, but it wasn't doing this at the time. But in its history, it was at one time 25% US stocks, 25% non-US stocks, 25% gold, and 25% REITs. Boy, was that a volatile fund. It was a crazy volatile fund, especially the gold by itself was just, you go more than 10% gold and gold will take over your entire portfolio. That was a crazy, ridiculous fund. They bought real estate thinking we want, REITs. They bought REITs thinking we want real estate for diversification, but that wasn't giving them diversification. That was the stock market, and it was a very, very volatile fund. So it's better to classify REITs not as real estate, but as stocks. And you may find this in your career. There's still a lot of funds out there that buy REITs thinking they're buying real estate. And REITs are not real estate. Probably the biggest mistake I saw was a 401k plan that started an inflation option. They wanted something that would do well during inflation. So they put tips in there, the treasury inflation linked bonds, but they also put a lot of REITs in there. And their argument was, well, REITs are real estate, it's a real asset, so if inflation takes off, they'll do well. And I told them, you need to go back and do some math, because REITs are high yielding stocks. High yielding stocks are often viewed as a kind of a quasi bond. They compete on yield. So when inflation rises and interest rates rise, REITs actually do really badly because they're competing against bonds on yield. They have high yields. So if you have stocks like REITs and utilities that have traditionally high dividend yields, they actually do badly when interest rates rise. So I said, you got this 401k plan, you're telling people it's going to protect them from inflation, and it's going to sell off dramatically if inflation takes off and interest rates rise. That may not be what those people are looking for. They may be, wouldn't you be disappointed Right now, if you had an inflation protection fund this year and you're down 20%, would that maybe upset you a little bit? It's like, hey, inflation's taken off. Sure glad about that fund. Let's see how it's doing. Oh, it's just sold off. That doesn't sound good. So NAREIT is a good one. I don't know why it says default there on the end, but NAREIT.com has better information. It's another kind of trade association. They do have good data. Look at all the buildings, right? You can just tell real estate people, they love buildings. Lots of read, how to invest. So interesting organization. It was interesting. Several years ago, they hired Ibbotson and Associates. Ibbotson Associates is this asset strategy group, and they wanted Ibbotson to sell REITs. So Ibbotson did analysis, and their analysis showed REITs no longer look like small company stocks. They now look like real estate. And so they took that around the country. They came and visited us. And I go, wow, that's kind of surprising. I have to check that. So I checked their numbers and they were absolutely right. That was true for the 1 year they did their analysis. And so I updated their analysis for the year after that, and it all went back to the old. So for 1 year, REITs look pretty good as a real estate substitute. Just the 1 year they did their analysis and then it went back. So REITs have not been a good substitute for real estate. I'm not saying REITs aren't good investments. In fact, the S&P 500 has broken real estate out as a separate asset class. It's the smallest sector in the S&P 500, not because real estate's small, it's just that very little real estate is sitting in these companies. Most of it is private. And there are two types of real estate companies. There's REITs and there's REOCs. So REOCs are real estate operating companies. They don't have to pay high dividends, but they're the same kind of thing. But they're not real estate. In my opinion, they're stocks. They look like stocks. They don't look like real estate. So I wouldn't kid yourself that you're buying REITs for diversification. I don't think you are. Now, what about residential real estate? Did you buy houses and rent them out? You can go for it. A lot of work. Really hard to diversify too. Can you really buy houses throughout the United States and rent them out throughout the United States? Would it be smart to buy 20 houses in San Antonio and rent them out? Would it be? Maybe. San Antonio has been a pretty safe market. What about in Phoenix? You don't go buy houses in Phoenix. You have to look, an expensive market, but maybe it should be expensive. California has some pretty expensive real estate. That's not my field. That's not something I like to do. I know people who have done that, and boy, it seems like an incredible headache. If you have 20 houses, how many bad tenants are you going to have? More than 3, right? It's going to be a pain. So it is a pain, but some people are really good at it. I've known some people who've done really well. But it's a different market. I used to say it's outside the realm of this class because residential real estate is not a market that Wall Street gets involved with. But that's not true anymore. I saw an Economist article. Actually, these big firms like BlackRock are buying a lot of residential real estate right now. So it is becoming part of Wall Street, and people are complaining about that. They're taking over these neighborhoods. A syndication, I'm not sure. I haven't heard that term with real estate. Well, REIT is specific to the U.S. tax code. So if you're a REIT, you have to follow the tax code and you don't have to pay taxes. If you're not a REIT, you can be a real estate operating company and you can put assets together and be traded like a stock, but you're not tax-free because you're not following the rules. And there are some companies that have organized as a REIT that I wouldn't think of as a REIT. So American Towers is a good example. Have you heard of American Towers? They put up towers for cell phones. Does that sound like a real estate company? Sounds like a tech company to me. But they organize themselves as a REIT. Why? Because they like the tax advantage. They're probably the most expensive REIT out there because they look like a tech company more than a REIT. So the word REIT itself is specific to the U.S. tax code, but real estate operating companies have very similar characteristics to REITs as far as their volatility. And a REIT can be private. There are firms that do private REITs, so you can create a REIT, but it's not traded on the market. It just trades, among sophisticated investors. The second one, and one of my favorite asset classes, is timber. What I like about timber, first of all, it's two asset classes in one. It's both real estate and a commodity. I love that about it. So it's hard to do timber without real estate. You agree? You're a little tough. But timber itself is a commodity, just like concrete or steel. It's a commodity that's used in construction and other things. So real estate, it grows trees either for pulp or for construction. You have hard and softwood. Historically, it's provided really good returns and has been a really good diversifier. We talked about REITs before. There are some REITs that do nothing but timber. So you could buy a timber REIT. It's going to look more like a stock than like timber. Most timber is just like with commercial real estate. You don't buy it on the stock market. You go directly to the seller. You give them 50 million bucks, and they give you an exposure to timber or to real estate. Timber, one of the reasons it's a good diversifier is timber tends to be a local market because it's so heavy. It may be great. U.S. produces a lot of timber. Canada produces a lot of timber, but it's a hard thing to sell to China. Can you imagine trying to put these massive trees onto a boat and sending them across the ocean? It's just very expensive, very difficult. So it tends to be a local market. Texas is a big timber state, East Texas, and the Texas timber tends to depend on the Texas economy. California is a big timber state. Its timber tends to depend on California and Washington. Canada tends to not ship that much timber here as to them just because it's really expensive to ship timber around. So it tends to be a very local one. So it tends to be more driven by local issues than by global ones. And so that gives you that diversification you're looking for. And then the other thing I really love about timber, I've tried to think of other asset classes that have this characteristic. There's probably a few, but none like this one. So let's say you don't like oil prices right now, and you've got 6 barrels of oil in your backyard. Your neighbors have been complaining, but you don't like the price of oil. Maybe you would that. Maybe 6 months ago you're like, I think oil's gonna hit 90 bucks. I'm gonna wait. What's gonna happen to that barrel of oil that sits in your backyard? Well, does it go bad? I don't know if oil goes bad, but is it getting any better? Are you gonna have more oil tomorrow than you had today? It just sits there. What if you have a timber farm and you don't like timber prices today, so you wait for 6 months? What happens now? You got more timber. It's wonderful, isn't it? It's what they call store it on the stump. Now, we make loans in Costa Rica to cattle ranchers, kind of the same thing, but cows don't live as long as trees, so it's not quite exactly the same thing. So if you don't like the price, you can just let it sit there, and while it sits there, you got more product. So you can fatten up cows. At some point, you get them as big as you can get them, and you can't go any further. But timber just keeps growing and growing and growing. So it's a wonderful, wonderful from that standpoint. And I've seen this, where I volunteer in Costa Rica. They're growing pine trees now. It looks like East Texas in Costa Rica. It's so bizarre looking, but they grow really well there. They're starting to harvest those now. It's providing a lot of employment in that area. I don't like it because I don't want to go to the jungle and feel like I'm in Bastrop, but it's working well for the economy there. I think those trees have been sitting there 15, 20 years, and now they're starting to process them, so it can take quite a while. So HTRG, Hancock, HTRG. Hopefully I can remember that. What color do you think their background is going to be? Green. Do you think green? There you go. Why aren't they showing a field with a bunch of trees toppled over and empty? They're sensitive about that, don't you think? They argue that they're good for the ecology because they're growing trees at all time. But really beautiful, beautiful pictures. Have y'all seen how they cut down trees these days. It's not an axe. It's this big machine that just grabs it and yanks it out of the ground. I mean, it's pretty amazing stuff. It's not the prettiest thing. It's not like, oh, that you don't have like Walton's music going in the background or something. Y'all don't know who the Waltons are, but so interesting firm. Probably the largest one out there. Very, very specialized. We met with them a few times. It's a pretty fascinating field. Boy, if I were 22, I would be tempted. So let's say you want to do this field. This is when they came and presented to us. Half my staff are hunters, and they're like, "Yeah, we want to do timber," and they just want to go visit these timber places and go hunting. They're like, "No, that's not a good reason to buy timber." But man, think about the career. So you get an undergraduate degree in finance, then you go to Texas A&M, get a forestry degree. You're set for life. I was talking to this guy. He was in this field. He's like, "Yeah, I spend most of my time in blue jeans and a t-shirt out in the forest." It's like, well, that sounds like a pretty decent job. You know, I get paid, a couple $100,000 a year to do that. So, yeah, that's kind of nice to go visit the forest. And everyone's had to go visit clients, but most of the time, this is back when we wore suits. So my department was like, "Yeah, this sounds like a really good career." But you'd be made. Timber is a big field. These are the type of firms you would work for, but you would not get a graduate degree in finance. That'd be a waste. You get a graduate degree in forestry. And I assume Texas A&M has a big forestry degree. I don't know who has the best forestry. I don't think you'd have any trouble finding a job, and I think you'd be pretty wealthy 20 years from now. I don't know. Kind of, if you're an outdoorsy kind of person, here's a career for you that pays you a lot of money to go out and spend a lot of time with trees. Do they have careers? I don't see anything on careers in here. So maybe I'm into contact. Where are they located? Boston. That's a good negative, not to go. But look where they're located in the US, exactly what we're talking about, right? California, Texas, Canada. And I don't know, I guess they have trees up in Maine. You notice they're not around the world, but there are some timber companies that are starting to spread around the world. So it can be global. It tends to be more of a one country type of business. So if you're really struggling for a career, do the deep dive, get a forestry degree. You better make sure you really want to do it, because I'm not sure what forestry is going to help you anywhere else. I'm not sure Google's going to hire you with a forestry degree, but so that's timber. Love timber, good asset class. And then the last one is everything else related to real assets, or all these commodities, which is obviously driving the news right now. We break it up: energy, agriculture, and metals. Those are the three main ones.
Is it timber a commodity?
I'm sorry?
Is it timber a commodity?
Timber is a commodity and real estate. It's both, to me. If you talk to timber companies, if they don't like the price of timber and they're building a major highway, they can just sell the real estate and make a lot of money. It's their choice. And it's even a business too, because they tend to do a lot of, they'll actually lease out their land for certain things. So, I mean, there's a lot of things you can do with timber, but yeah, it is a commodity. A tree itself is a commodity, but the real estate it's growing on is real estate that can be sold like it is real estate. All right, so commodities are sensitive to the economy. So if you have a recession, commodities tend not to do well, but they do tend to do okay in inflationary environments. So if you have an economy that's just taken off because of inflation, like in the 70s, or like right now, they'll tend to do fairly well. A good website for this is FinViz. There's a lot of stuff on FinViz that's really good. First, I like this thing here. They're showing this at the Investment Society, but they just show you what stocks are moving. I might have shown you all this before. But right here, they have futures. Well, other thing they do is they show you, here's a stock, BDSI, it's up 52%. Here's a stock, Dave. There's a stock named Dave that's down 37%. You can see what's up and what's down. So top gainer, new high. So they just hit a new high. I didn't say it's up 52% over the last 12 months. The stock is up 52% today. So why didn't y'all buy it yesterday? Because it was Sunday, right? You should have bought it on Friday. You weren't paying attention on Friday. You should have bought this stock on Friday. This could be a penny stock, right? It could be one of those just bouncing around. Why is Dave down 36% today? Who knows? But you click up here on the futures and they will show you these markets. So up here are the stock market. So that's not part of the commodities. There's the VIX we were talking about before. But then you get into energy. So crude oil, West Texas and Brent. And this is the one, I mean, it's kind of interesting. Brent's up and West Texas is down. Oh, sorry. That's the one thing I don't like about them. Boy, they've gone crazy on their advertisements. So there's oil. It was only at 64 bucks. And now it's at 94. So oil's up dramatically right now. You got gasoline. Gasoline prices are obviously up a bunch. People are complaining about that. Heating oil, natural gas. Natural gas is an interesting one because natural gas just stuck there for $2 forever and ever and ever. But now it's finally kind of doubled in price and gotten up there quite dramatically. Ethanol. And then you get into the agriculture, cocoa, cotton, orange juice, coffee. See, they're all up. There's lumber right there. Lumber's done fairly well the last year, last 9 months. You look longer term. It's been pretty volatile the last few years. Sugar's down. I don't know why sugar's down. Gold, silver. So here's agriculture, more agriculture, soybeans. Look how much soybean prices are up. Corn prices are up. Wheat prices are up recently. Rice prices are up. Oats, canola. So a lot of food prices are up. And then you get into metals. You have gold, which is a precious metal. And you have silver, which is a precious metal and a production metal. So silver and gold can be very, very different. Gold is going to do well with inflation, weak dollar, low interest rates. Silver does well in that as well, but silver is also used in construction. So when the economy is weak, people buy less silver because of the production asset. Gold is not really a production asset, so it's not as sensitive to the recession as silver is. Platinum, copper, palladium, and then you get some more agriculture, cattle. That's where we do our loans. So I'm glad to see cattle prices are up. Hog prices, what just happened recently with hogs? I'll watch the news on that. Why are hog prices up? Isn't China killing a large portion of their pigs because of a disease? So, you know, that's going to definitely, that may be what happened, right? You see that huge jump there? That might have been news from China. That huge jump right there. So each one of these have their own little life, their own world going on, interesting stuff. If you're looking for a career in finance, one of these boxes could be your career. You could spend the rest of your career trading coffee futures. That could be your entire career. Does that sound interesting? Maybe. I don't drink coffee, so I don't know. I find that all the interesting. Orange juice. What might make orange juice prices suddenly jump up? Or a hard freeze in Florida might do it, right? Why are orange juice prices down? I have no earthly idea. So coffee prices are up, orange juice prices are down, sugar prices are down. I don't know why sugar prices are down. But cocoa prices are up. I don't know why cocoa prices are up. I don't know these markets. What was interesting to me is I was talking to an oil trader, and so I say, hey, you know, you're an oil trader. What do you think oil prices are going to do? He said, oh, we don't really think about that. I said, what? You're an oil trader? No, we're just watching backwardization in contango. We're just, so there's like, he didn't care about oil price. Like, how can you be an oil trader? You don't care about the oil market. It's like, no, I care about the oil's future market. That's what I know. So you get really specialized in these fields. It's pretty amazing. So any one of these boxes is an entire career. So it's interesting stuff. And they show you, you know, ethanol's up a bunch today. Cocoa's down a bunch today. What do you notice about the stock market on this graph? Where are they located? Talking bond markets. They're not at the edges, are they? What's on the edges? How far do you have to go to get an actual market? Japan, down 0.13%. The VIX, but the VIX doesn't really count. There's a 30-year bond. So this is almost always true, is commodities are on the ends. They're very, very volatile. But if you had ethanol and cocoa in your portfolio, one would have been up a bunch, one would be down a bunch. You'd have good diversification. So that's where you get the diversification. They kind of have a life of their own. They're all over the place. And why is Brent oil on the top? So I don't know when they did this chart. Kind of interesting because it doesn't match up here. But you know, so these are the kind of things that when you're buying commodities, this is what you're looking at. The question you have to answer though is, if I buy commodities, how do I want to allocate between energy, agriculture, and metals? And I gave you two ETFs. One is the S&P GSCI, the other one's the Dow Jones AIG. And they buy commodities. So if you buy them, you have commodities, but they're radically different. The S&P GSCI is like 60% energy. The last time I checked, I don't know what it is today. The AIG is only 31% energy. So they're not the same. They're very, very different. So you probably would have wished you had the GSCI this year. That would have made you really, really happy. But I gave you links to them. If you want to go on their links and see, they'll give you the breakout and what they do, and they'll give you some details on them. You can buy these like any other stock. You can just buy them like a stock. And unlike REITs, you know, REITs don't move with real estate. These will move with the commodities because commodities are traded every day. So we have a lot of confidence in the price. All right. So where I said I don't want to buy a real estate investment trust to try to get real estate, I would buy S&P GSCI to get exposure to commodities because it's going to move very much in line with commodities, a high correlation with them. But which would you rather have, 60% energy or 31% energy? Boy, just if you got that figured out, then you're going to be really rich because that's a tough thing to answer. Any questions on commodities or real estate or timber? It's a big part of the alternatives. Not everybody has them. A lot of people don't own any of those things. They're just stocks and bonds, which if you take my risk class, I'll talk about why that's so dangerous. And then you have other real assets that I know practically nothing about. Artwork, collectibles, maybe Bitcoins would fall in here, very specialized markets. Yeah, I do like to watch art history podcasts and YouTubes and listen to what art prices are doing, are they up or down? It's, you know, it's pretty amazing. If you know what you're doing, yeah, you can certainly make some money there. This is kind of old, a couple years old, so it's probably not current today. But you can see the way this particular article broke them up. And then there's an index. Someone might Google this, COUTTS Passion Index. Now they say it's up 90% since 2005. That sounds really good, but that's not 90% a year. That's 90% over 15 years. So it's not all that impressive. The other thing is, I just showed you Vanguard. You buy a Vanguard fund, they're going to charge you 4 basis points a year. You get into this market, you're not paying 4 basis points. It's a very expensive market. You're going to lose a lot of money every time you buy or sell just because the commissions are high, and so it's a market you better know what you're doing. Do y'all watch the Antique Roadshow ever? You know what that on PBS? I always just click to the end to see how much it's worth. I don't really care about all the history stuff in it. It's kind of boring, but I'm just like, I look at this teapot and say, yeah, that's probably worth $2,000. Says, oh, this is worth $87,000. Oh. So, I don't know anything about that kind of stuff. Classic cars are up a bunch, at least at that time. This is before the used car thing took off here recently. Coins, I had a student, that's what he does. He's a coin guy. He knows coins backwards and forwards. That's great. There's a guy in Costa Rica, I kid you not. His special art was beetles. He sold beetles. He produced beetles. He found two beetles and put them together and created the beetle that didn't exist before. He sells those things for several $100s each. That's pretty specialized. It's not on my list here. He wanted us to loan him several $1,000s to create a lab so he could do it more. And he's an older gentleman. And we're like, well, what happens if you die? We didn't word it that way because he refused to teach anyone else what he was doing. Not even his own son. It's like, no, they got to figure it out on their own. It's like, yeah, but if we loan you money and you die, we're kind of, the local university, we're up, people are visiting him because he's kind of a celebrity in the beetle world. There is a beetle world. This world gets really specific. So he was really famous in the beetle world because he's creating beetles that didn't exist anywhere else, selling them for a lot of money. So this is a area where you better know what you're doing because it's pretty political. It's pretty sensitive to what's going on. I mean, think about China. China got the party in China got real upset with some of their wealthy members kind of showing off their wealth and buying all this artwork and that kind of stuff. And they say, hey guys, kind of tone it down. And that caused a huge sell-off in some of the prices here. So, all right, next class, we'll talk about venture capital. If you want to volunteer to share your answer to question 1, let me know. And then Thursday, we'll definitely start the tactical side. I'll let you out a little bit early. So finish up alternatives and then get into the fun stuff, which is the tactical side, where it's, you know, if you're really going to kill it, you're going to really ace an interview. This is the tactical side is what you got to know. So alternatives. The only alternative we're going to cover is venture capital. You might say venture capital / private equity. Venture capital is you're starting a brand new firm. So it's a venture, brand new venture. Private equity it's just a firm that's not publicly traded. So venture capital would be a brand new firm. Burger King or Dell Computer, 2 firms that went private. They're not ventures. They didn't just start. They're huge companies that went private. So, you know, Michael Dell could fix everything and then go back public again. So I kind of mix those two together, but venture capital, private equity, it's a way to buy, not always small companies. There are some large private equity firms, but it's a way to buy usually smaller companies. And you don't have to worry about the daily fluctuation in stock prices because they're not publicly traded. You don't know what they're really worth. So non-public companies, and they have what we call the J curve. So when we did private equity where I was, a firm would come in and a general partner would come in and say, hey, we're starting a fund. We're raising $300 million. We want to know if you'll put 50 million. And we'll say, what kind of firms are you doing? Oh, we're doing healthcare, or we're doing energy, whatever. We say, okay, that's interesting. And usually there's a 10-year window. So we commit to them. So we'll say, we'll give you 50 million bucks. And over the next 10 years, you're going to buy these firms. You're going to start them up. You're going to get them funded. And then somewhere around year 7 or 8, you're going to start IPOing these. You know what IPO is, initial public offering. You're going to make them not public and make them non-public and make them public. Somewhere around, you know, 5, 6, 7 years or so, they start going public. And hopefully you make more than your $15 million back. We don't write them a check for 50 million. We commit 50 million. They may ask for 5 million next week and 10 million in 3 weeks and 20 million, you know, a little over time. They don't want us to send them all the money all at one time. Because of that, private equity is very year focused. A 2017 fund might do a whole lot better than 2018 fund. It's just, you know, the luck of when you funded the thing. And so we have what we call the J curve. If you think of a J curve, I couldn't get a J that looks like a J curve, but you know, it starts off cash outflow because you got to fund it, and then it's somewhat flat, and then suddenly you start getting cash back. But there's a quiet peak period in the curve of the J where nothing's happening. And I got this portfolio when I was at UTSA, and literally, the lady who had it before me, she showed up with a shoebox of paper and said, here's our private equity fund.
Yes, so I had an understanding that non-public companies were companies that were not selling stocks. So is that wrong? Or is it?
Well, they're not on the stock market. You can't buy them on this. You can't go to your broker and buy them.
Okay.
I mean, USA is a non-public company, but it's not really private equity. It's a non-public company, but it's owned by its customers because it's an insurance company. So it doesn't really fit in that category.
So how do they go about selling their stocks?
Well, when they go IPO, they go out and they find an investment banker, and the investment banker is going to underwrite, and they're going to say, hey, oh, there's a lot of firms now that are going public without even going through the investment bank. And there's been some pretty interesting, the last few years, there's been some interesting alternatives. But they decide at some point, you know, they're solid, they're doing well. We'll actually talk about this a little bit when we get to beta. If you're Mark Zuckerberg and your Facebook is private, the second you go public, you might have an investment worth $500 million. As soon as you go public, it's going to be worth $5 or $6 billion. I mean, your net worth, and that's the nature, because public companies are in well-diversified portfolios. Private companies are not. You can't, you know, you own the company. And so as soon as you become part of a well-diversified portfolio, your discount rate goes down a bunch, the value of your firm goes up. You know, Zuckerberg might say, you know, I would have preferred to have been a private company. They don't have all the stock market, you know, all these stockholders after me. But if your wealth goes from $500 million to $10 billion, you might have an incentive to go public.
I actually have a question. Like, what about for, like, I know HEB, I know that if you work with them like for a certain amount of years,
Yeah.
they like, you know, have that.
They
for
assign
their
a value.
employees. And so like, is that an actual good benefit for their employees?
It's a good benefit, but if you were in the Butt family, if your net worth is $10 million, the second guy to go public, your net worth is going to jump 15, 20 times. It's really hard for them to stay private. And Mr. Butt might say, I want to be private because I don't want the mess. I like my firm. I got enough money. Then he has 4 butts and they're like, well, we're okay. And then they have 40 butts. At some point, someone's going to say, you know what, if I can turn my 2 million into 20 million, let's go public. At some point, the Butt family is going to say, enough of this. We're not going to be in the market. We don't want all this hassle. So yeah, it's okay to say, you know, 20 millions, 100 million, whatever they're worth. 100 million is good enough for me. But at some point, that 100 million is worth 2 billion. You're kind of like, let's go for it.
What is the main driver of that discount rate? You said,
Well, we're going to talk about beta. So beta assumes you can ignore 80% of the risk of a company because it's going to be diversified away.
well, what makes it diversified?
Because if you own HEB, your HEB family, you got 99% of your money in HEB. That's not well diversified. If Walmart comes in and takes over your market, you're going to lose that entire thing. But if HEB is part of a well-diversified portfolio, the company-specific stuff related to HEB, that gets diversified away. Because if HEB fails because Walmart does well, and you got HEB and Walmart in your portfolio, you're okay. We'll talk about that. That's what beta is all about. Beta is about what risks do you care about as a stock investor. And beta says you can ignore 80% of the risk of a company.
So just because it can be used as a tool for diversification, it gains value?
Well, your discount rate, if you own HEB and you're the only owner and it's private, your discount rate might be 37%. That's a pretty risky investment. You got all your money in one company that sells groceries. All right. Your discount rate for HEB, if it's a publicly traded grocery store, might be 6%. If you go out and discount a cash flow at 30-something% versus 6%, the valuation is going to go up many fold. Yeah, it's really hard not to go public because your wealth jumps dramatically. It's just that it's hard to diversify if you're the owner and that's the only business you have. But as soon as your company becomes part of a well-diversified portfolio, the people buying your stock, they don't view HEB as their only investment. They view it as a small piece of a bigger investment. So they use a much lower discount rate. So the value of your company goes up dramatically. We'll talk about it a little more when we talk about capital asset pricing model. These companies have a strong incentive to go public. It makes their valuations much higher. And so, yeah, so at USA, I got a box of these things. We didn't do much. I don't think they ever got much more than a few $100 million. It's just wasn't something USA wanted to spend a lot of time on. It didn't have a lot of resources. So I've watched these. We had some really good IPOs. You know, you've heard of some of the firms. Oh boy, Charles Rivers, you probably heard of. I can't remember the name of the health company you would have heard of. But some pretty good firms came out, and then there were some that just didn't do anything. And we had one investment. It was sitting on our books like for $300,000. We're like, is there anything? And the guy kept saying, yeah, we think there may be something there. We finally just wrote it off. So, hey, if there's something there, we'll get it. If not, then we just wrote off 300,000. So you have a few that do really, really well. You have some that are kind of mediocre. You have some that just go out of business. But the nice thing is, it's not the average that helps you because it's very skewed. The most you can lose is 100%. But the ones that do well can be up, 40, 50,000%. So you only need a few that win, and the others can do really poorly, and you come out ahead. So it is an interesting investment, pension plans, public funds. They love venture capital, Harvard and Yale, and those type of. They like this. It's a lot more fun to deal with this because it's kind of cool to look at these ventures and their startups. Whether they really are a better investment than just buying small company stocks in the public markets, that's hard to say. The analysis I did is USAA made the exact same money doing private equity as they would have if they just had bought small company stocks. They would have gotten the exact same return, so it really didn't add much return. Now, would you want to work in this industry? It's really tough to go from college into this industry unless you're at UT Austin or MIT or Harvard. Venture capital tends to hire from very select schools. That's why there's a lot of venture capital in Austin. So if you want to do venture capital, Austin's a good place to go. So get your master's from, Red McCombs, and it might work out. Or you go work in industry, and then a few years later you come back and apply for venture capital. They would hire you if you have some experience, but it's hard to go right out of a school that's not a venture capital school. They tend to group themselves around major universities so they can instill those students. That's just the nature of them, and they have certain schools that really focus in on that. Interesting area. So will HEB go public? Eventually, I think it will. I have no idea what it might be worth. It's an impressive firm. It's Walmart's put a lot of people out of business, but not HEB so far.
Sorry, what do you think is like the fear to go public for that?
Well, it's the same thing with Zuckerberg, is that stockholders are very demanding. And the Button family may say, we're not making really good. Maybe they're making 7%. They should be making 10% or whatever. And they're like, that's good enough for us. If we go public, we're going to have these stockholders demanding higher margins. I wouldn't mind a family-owned business where my return's not as great as it should be, but it's enough and I'm happy and I'm serving the public. That may be his attitude. He just prefers it to, it's his money. He can do that. But if he goes public, yeah, the rules all change. The stockholders are going to say more return, more return, more return. So what else could be an alternative? Some people say hedge funds. I don't consider a hedge fund to be an alternative. I consider a hedge fund a way to invest in other asset classes. A hedge fund is a way to invest in stocks. A hedge fund is a way to invest in bonds. So I view it as another place. It's really a way to beat the market. I call it an alpha play. It's a way to try to beat the market. So hedge funds are really not an asset class. They're really more of a strategy that add extra return. You should know what hedge funds are. It's pretty easy to go and look up the major strategies for hedge funds, whether it's market neutral or global macro, those type of funds. There's a pretty short list of the major ones, but I don't consider them a separate asset class. I don't consider derivatives, options and futures. We'll talk about them later. I don't consider them alternative asset class. Options and futures is just another way to buy stocks, another way to buy bonds. You might do it in a risk controlled way where you eliminate some of your risk, but I don't consider them an alternative. Some say currencies are an asset class. You certainly, if you wanted to Google a term, an interest we want to Google would be currency overlay strategies. So currency overlay strategy, this is where, let's say someone's buying developed market stocks. So you hire someone to say, go out there and get the best stocks in the world outside the US. And they do that, and they really like Japan. So they buy a lot of Japanese stocks. Well, when you buy Japanese stocks, you're getting two things. You're getting Japanese stocks, and what else are you getting? You're getting the yen. What if you like Japanese stocks, but you don't like the yen? Where you can hire a currency overlay manager, and they'll say, okay, buy the stocks you think are the best, and then we're going to look at your portfolio. And if we don't like the yen, we're going to sell the yen, we'll buy the euro. So you got your stock manager buying the best stocks, and you got your currency overlay manager managing the currency exposure on top of that. So it's a pretty popular strategy. Usually dominated by the economists because currencies tend to be a very economic field.
Could you also, like, some firms, like in China, they have ADRs. You don't buy it in Chinese dollars, you buy it in American dollars.
Yeah, but you still have the exposure to the currency.
Well,
In ADRs, you still get, I mean, it's in pricing US dollars, but the currency still flows through. So you'll still see it. And you can hedge that out, but yeah, ADRs they're priced in US dollars, but the stock movement, because if that wasn't true, there'd be a big arbitrage opportunity between the stock in China and the stock in the US. And markets would arbitrage that away. So you're picking up that same currency risk, and you can arbitrage it out if you wanted to. But yeah, ADRs is just a way to get it so that it's easier for the US stock investor to buy it, but you're still picking up that currency. The ADR doesn't take the currency risk and shift it out. Just because you're buying it in dollars, you're still getting that same, because it's going to price off whatever that stock's trading in China with the currency adjustment back to dollars, and that currency adjustment back to dollars is always going to happen. So you're always going to see it. But you can hedge it out. You can definitely buy an ADR that's maybe in euros, and you can hedge out that euro exposure if you want to. Or you hire someone that will do it for you, and they may not hedge it out. They may like the euro, so they may actually buy more euro and short the dollar or something like that. So hedge fund strategies, yeah, there's a lot of them out there. Long short equity, market neutral, global macro, managed futures, convertible ARB, statistical ARB. There's a lot of strategies out there. Most of them involved buying something long and shorting something, longs and short trades. So most of them, like global macro, we were a big fan of global macro. The key there is you look at all the equity markets, all the bond markets, all the commodities, and you decide what looks cheap, what looks expensive. You buy the cheap stuff, you short the expensive stuff. So maybe you buy German stocks and you short UK stocks. Maybe you buy oil and short natural gas. So you're buying and shorting stuff. And that's why that phrase, global macro and market neutral, what you're trying to do is set up something that if you're right, you'll make money, but if the market crashes, you can still make money, because if the market crashes, as long as what you're long on goes down less than what you're short on, you still make money. So you're not as exposed to the market. So you tend to be a little bit better diversified. Could you work for a hedge fund right out of college? I don't think so. I doubt it. The hedge funds I met with, first of all, they didn't hire finance majors. They hired mathematicians and engineers. But a lot of very, very mathematical fields. I remember I visited one at Deutsche Bank. Looked like a really cool place to work. There were seven people, all scientists, really low key. It was like really quiet office, low lights. And they would sit there all week. They had an idea. So I think every time this happens, this happens. And they spend all week trying to see if that's true or not. If they find something, hey, I think I found something. And the boss says, oh, that's interesting. Let's put some money into it. We'll put it in what we call an incubator. Let's try for a few months, see what happens. It keeps working. And about a year later, say, hey, you know what? This is working pretty well. Let's put it in some of our clients' portfolios. And then you go out to your clients and say, hey, we just have this new commodity strategy. Are you interested in it? So they have this idea. They just sit and work on it. They may work on it for a month or two. And then they'll incubate it for a year, and then they'll put it in clients' money. So, I mean, it's kind of a low-key job. You better come up with something, but you don't have to have something every single day. But if you sit there for a year and don't come up with anything, they're probably going to be a little irritated with you. But yeah, it's very much the scientific method type of job. You're looking for things that make sense statistically. You have some rationale, and you put it into a fund. So you could do it. What if you want to start your own hedge fund? I have a good friend who did that. He had about 15 years of experience, lived as cheaply as he could, started his hedge fund with his own money and his family money, mainly just a few $1,000,000. He didn't have a whole lot of money to start with. But the key is once you start the fund, you start a history. And once you start a history, the consultants all pick up your performance. And after 3 years, you have 3 years of history. You don't have to do anything. The consultants will sell your fund for you. So it's kind of nice. So you got 3 years of history, and suddenly people are calling and say, hey, we want to put $1 billion with you. He's like, okay, we'll do that. Bring your money over. So it wasn't bad. I figured in a really, really bad year, if you really had a horrible year, he might only net $800,000 in income that year. That would be his worst case year. Normal years, he was well up into seven digits. Not a bad life. He is him and one partner and then one IT person, 3 people. I visited his offices, and his office was like as big as this room. I'm like, why do you have a room? He's paying $7,000 a month for a big office. Why don't y'all just work out of your house? You know? But anyway, they needed an office. But so you can do it, but you've got to get some. You got to get some history. Once you build your history and it gets into the consultants, you don't have to hire marketing people. People come to you, so it can work, but you better have something that actually works. You better have an idea that's a good investment idea. If you don't have a good investment idea, it doesn't matter what you do. No one's going to hire you. But if you have a good investment idea and you didn't waste money buying expensive houses and cars, and you can live cheap for 3 years, after 3 years, yeah, you may be very, very wealthy the rest of your life, be sure. All right. So real quick review, question 1. We just finished question 1. You can define an investment portfolio. You got the 3 questions. Remember the 3 questions? Why are you investing? What's that liability? And you're going to look at the horizon that you're investing. What can you invest in? The asset classes, you want to be parsimonious. How are you going to invest it? You're going to do it yourself. You can hire someone else. You're going to be passive, be active. Have the major asset classes you're going to define. Look at the subcategories and the strategies. So major classes are cash, bonds, stocks, and alternatives. Cash, you want to talk about cash versus bonds. That's important because they're really the same thing. You're just loaning money to somebody. So how do we distinguish between cash and bonds? Talk about cash. Cash doesn't have subcategories, so you just give some examples and talk about it. Then you get the bonds, the EC cuts I. So just remember on duration, define duration is how sensitive the bond's price is, the changes in interest rates. The subcategories are short term, intermediate term, and long term. And then the strategy, you expect rates to rise. What do you want to do with duration? Shorten, expect rates to fall. You want to lengthen duration. So you do that on each one of those, define it, subcategories. Stocks, make sure I didn't put that in here, but there's an introduction to stocks that's really, really important. What is a stock? What's an expected return on the stock? Where does that come from? You remember it's dividend yield plus earnings growth, and earnings growth is going to be closely tied to economic growth. So that whole introduction, I should have put that there. Anybody remember the bucks? Anybody do DC cuts I and bucks? One person do DC cuts I and bucks off the top of your head without looking at your notes. Anybody there? All right, go Rose.
D for duration, C for expectancy, credit, U is US versus non-US, T for taxes, S is for structure, I for.
What's the Fed worried about? Yeah. All right, very good.
D is for beta, U is for US versus non-US, C is for. I'm gonna be honest, I forgot C, but I know S is style.
Style. All right, very good. Anybody remember C? Capitalization, the size of the firm. So in capitalization, it's how big is the firm? You have 3, maybe 5 categories there: large cap, mid cap, small cap, micro, and penny stocks. So you see the formula here. Be careful that the U here and the U here are very different things, right? For bonds, most people don't consider to you for bonds because of the currency risk, but for stocks, non-US stocks is very, very popular today. And the alternatives, why do we buy alternatives? Usually gives us diversification. If it's real assets, it might protect us from inflation. So you see how you're going through each category. I haven't had anybody volunteer to give me to share their answer. So make sure it's in your own words. Don't do any copying and pasting. So if I'm reading my class notes, then, I might really love my class notes. I think they're really wonderfully written, but I'm not going to give you credit for my work. Make sure it's well organized and logical. I've essentially given you the organization, so just follow that. Some students have asked, can it be in bullets? You can have bullets and numbers and places, but don't make it look like an outline. Make it look like a paper, all right? Make it look professional. Everything you do, make it look professional. So it should stand on its own. That's one reason I don't want all bullets. Someone looks at it, they know what, someone who's not in the class should be able to read it and it makes sense. All right, does that, you understand that? And if you want to do extra stuff, that's always good. That's always a bonus. If I don't get a volunteer, I'll show you the best paper from last time. I'm still worried about showing you that paper because it was really, you went really, really not overboard. I mean, especially on convexity, you went out there and did a lot of extra, but that's the organization. That's how you're going to do it. What about the second question, the tactical? So we're going to practice that today and on next Monday. So I'm going to give you a scenario or a forecast. And I'm going to give you a list of asset classes. And you're going to tell me, what do you like? So you want to overweight. And what don't you like? So you want to underweight. And some students don't know what under and overweight means. So just be real clear. Overweight means you really like it. So if you normally have 10% in that asset class and you really like it, maybe you go 15%. If you normally go 10%, you hate this asset class, maybe you cut back to 5. All right. So overweight means you have a higher allocation. Underweight means you have a lower allocation. The key components here is, first of all, you got to ask about stocks versus bonds. That's pretty easy. You're looking for, is your boss expecting a recession or a strong economy? If she expects a strong economy, what do you think you're going to do with stocks versus bonds? Stocks, right? If she says, I'm expecting a recession, what would you think? Bonds, and what kind of bonds? Probably high quality and longer duration, right? What's going to happen in a recession? You want higher quality bonds and interest rates will probably fall. All right, and then with bonds, if you look at this, duration, convexity, quality, taxes, inflation, structure, of those, you'll definitely get one on duration. How do you answer that question? Are rates expected to rise or fall? Pretty straightforward. You'll definitely get something on convexity, and that's going to be related to, are you expecting rates to become more volatile or less volatile? All right, you only have one thing to watch for there. Quality, pretty straightforward on credit. If you're expecting a recession, you want to be higher quality. If you're expecting a strong economy, you can go lower quality. Pretty straightforward. Taxes is the only math on the first exam. Is that, do you buy the municipal or you buy the taxable? Which you buy, you're going to make that tax adjusted yield and make that decision. I'll give you munis and corporates that are the same duration and the same quality. So the only question is the tax piece. So just make that adjustment. Inflation is pretty straightforward. Are they worried about inflation or not? If they're not worried about inflation, you probably don't want to buy tips. Not going to really help you much, especially with the negative yield. Structure and US versus non-US bonds, I don't put on this exam at all because there's almost no way I can put it on the exam. For stocks is almost all related to the strength of the economy. So you're just looking for it, recession or strength. So if you're expecting a strong economy, then go higher beta, go cyclical. Expecting a recession, go lower beta and go defensive. If you're expecting a strong economy, go smaller cap. Expecting a weaker economy, go larger cap. Style, expect a strong economy, you can do more value. Expect a weak economy, probably move more to growth. Remember, value is low quality. And then US versus non-US, you got two things there. The relative strength of the countries, and I've got to tell you that. Okay, something I have to say, well, I expect Europe to do a lot weaker than the US. I expect emerging markets to do a lot stronger. You know, I'm just going to have to come out and just tell you. But the other thing is on currencies. So I expect the US dollar to be really strong. What would that tell you for non-US stocks? A strong US dollar, do you want to buy non-US stocks? Probably not, because that's going to hurt you. Notice it gets a little tricky, but the way I write the question, I mean, it's a little tricky because one of the reasons currencies weaken is so that the country can make its exports cheaper, and that will actually help their companies. So I'm avoiding that. You're going to see I write the question so clearly, you won't have that issue at all. And in alternatives, if there's any inflation concerns, then maybe if there's some real assets in there, like commodities or real estate, that might work. If your boss is worried about diversification, or I might just tell you, your boss might say, hey, I really think commodity prices are inflated right now. I'm expecting a recession. This is a horrible, and it's pretty obvious, right? I'm going to underweight commodities because she's worried about commodities. All right, we'll practice this quite a bit because get into this. So here's the key on this question, because you're going to do it in class. I'm going to limit you. You only have 30 minutes, so you have to move fast. And I'll tell you, there's always either 17, 18, or 19 things that you have to say. And I'm going to show you what they are. And some of them are always there. You will always have a comment about stocks versus bonds based on the economy. I expect a recession. You should be saying we're going to overweight stocks. Overweight bonds, especially high quality bonds, underweight stocks. On treasuries, there will always be two things that you need to say on treasuries. One is related to duration. If I expect rates to rise, you want to shorten your duration on treasuries. The other thing, if I expect a recession, what would you think about treasuries if we expect a recession? Would that be an asset you would want to buy or an asset you want to avoid? Your boss is expecting a recession. If you said, yeah, I think you should buy more treasuries, which you think you're something wrong with you, or would that seem pretty normal? What do y'all think?
You don't want more duration during the recession.
Well, we're talking here is quality, though. You're expecting a recession. So you want high quality. Would treasuries be a good investment if you're expecting a recession? How did treasuries do in 2008? They did wonderfully well. They're probably maybe the highest returning asset. So if your boss is expecting a recession, Jose, you're right. If your boss is expecting a recession, and you probably want more duration because rates are going to fall, but you also want higher quality. So if I gave you long-term treasuries and your boss is expecting a recession, that's probably an asset you want to overweight. If you tell me we're going to have a recession next 12 months, I'm going to buy some long-term treasuries. Interest rates will fall, and those things are going to do really, really well. They're going to be the place to be. I think long treasuries are up like 35, 40% in 2008. Would that have been would your boss have been happy if we're up 40% in a year when the stock market was down 35? They'd probably been pretty happy, all right? So in treasuries, under treasuries, you're going to write two things, one related to duration and one related to quality. Now, I have to be real careful. You're going to see when we practice this, you got to be real careful on the exam that it is two things. Because if you say on the exam, well, I want to overweight treasuries because we're expecting a recession, you get 1 point. But you say, well, I meant because we're expecting a recession and rates are falling. You didn't tell me rates were falling the length of duration. So I didn't know that piece. All right. So if I tell you we're going to have a recession and rates are falling, you can't say overweight treasuries because I don't know why. You can't say overweight treasuries because I expect a recession. That only gives you 1 point on quality. So you have to say, I want to overweight treasuries. First of all, we're expecting interest rates to fall, so I want to lengthen duration. Secondly, I want to overweight treasuries because we're expecting a recession and want higher quality. All right, you got to make it real clear that there's two things there. Treasuries are both high quality and have a duration. So long-term treasuries are both long duration and high quality, and you got to talk both of those. We'll see as we practice it. Tips are pretty straightforward. Only one thing. Did the scenario say anything about inflation? If it said your boss is really worried about inflation, then maybe tips would have been a good thing to overweight. If your boss says, I'm really not worried about inflation, then tips might be something that you wouldn't put in there. Mortgage-backed securities, only one thing. I've had students add other things, and we may talk about some scenarios where you might, but I'm only looking for one thing. Your boss says, I'm expecting more volatile interest rates. You want to avoid mortgage-backed securities. If your boss saying I'm expecting interest rates to become less volatile, you would want to overweight. So that's the only thing you have to worry about. One thing on mortgage backs. Municipal bonds, this is where students lose a lot of points. There's three things here. Municipal bonds can be high quality, medium quality, or low quality. They can be short-term, intermediate, and long-term. And then municipals are tax-free, whereas corporates are taxable. So you see the three things there you got to talk about. If I'm expecting a recession and I have medium quality munis and corporates, you probably want to weight them. You probably want to move to high quality. If I'm expecting interest rates to fall, and I have long-term intermediate, I have long-term corporates and taxables, you probably, that wouldn't be bad. How long-term you're expecting interest rates to fall. And then the tax question, you just look at the formula. So right now we got 1, 2, 3, 4, 5, 6, 7, 8 things on that page that you have to talk about. High yield, there's only one thing to talk about on high yield, and that's quality. If you're expecting a recession, would you want to buy high yield bonds? How did high yield bonds do in 2008? They sold off almost as much as stocks did. How did it do in 2009 in recovery? They were up as much as stocks. So high yield, if you're expecting a recession, you don't want high yield bonds. I have students say, I want high yield bonds because I'm expecting interest rates to fall. I don't know anyone that buys high yield bonds based on duration. High yield bonds are a strong economy. They're great. Weak economy, they're to be avoided. So quality is the only thing there. And then we get the large, small, and developed students. There's a lot of points here because they don't fully give the answers. So on large cap, there's 2 things I'll give you out of 3. It could be a quality thing. So large cap are higher quality than small cap. So in a recession, you'd rather have large cap than small cap. I might give you large cap cyclical stocks. So how many things are there? Large cap cyclical stocks, you got 2 things there, right? You got large cap stocks and you have cyclical stocks. You got to address both of those. All right. So let's do large cap defensive stocks. You're expecting a recession. How will large cap defensive stocks do versus small cap cyclical stocks? Which would you rather have? You're expecting a recession. You have a choice between large cap defensive or small cap cyclical. What would you do? Large cap defensive. For how many reasons? 2 reasons. Large cap do better than small cap in a recession, and defensive does better than cyclical in a recession. All right. I'll see that there's 2 things there. If you say I prefer large cap defensive because I'm expecting a recession, you only get 1 point out of 2. All right. So you need to say, so the best thing to do on the exam is, there's going to be 2 bullets here, then write 2 bullets. Put 2 things in your answer. Don't combine. All right. If I can't tell that the large cap defensive is both large cap and defensive, it's really 2 asset classes in one, then you only get 1 point. So put 2 bullets there. Same thing on small cap and mid cap. There's a quality issue, there's a beta issue, and a style. You don't know which I'll give you. I might give you small cap growth stocks. I might give you small cap value stocks. I might give you large cap cyclical. Who knows what the combination is going to be, but you're going to see 2 things there. You got to talk about both of them. I always keep it consistent. So it's not like, I'm expecting a recession, you got small cap growth. Well, small cap doesn't do well in a recession, but growth does okay in a recession. I'm not going to do that to you. So I'm going to keep it consistent. But know that you're going to have 2 bullets there. Developed, you'll always have 2 bullets. One's on the quality. Which countries are doing better? If Europe and Asia are expected to do better than the US, then you'd want to overweight developed market stocks. If the US dollar is expecting to weaken, you'd want to overweight these. So there's something on the quality of the economies and something on their currencies. All right. So we said 8 on the other page. So we got 9, 10, 11, 12, 13, 14, 15. We were up to 15 things so far. Emerging markets, it should be the easiest one of all. I don't want you to talk about currencies on the emerging markets because it's really kind of messy on currencies on emerging markets. There are a lot of emerging countries that peg the US dollar, or they're commodity driven, and the commodities are pegged to US dollars. So emerging should be the easiest one. Your boss thinks emerging markets are going to really struggle in this environment. What might you do on emerging markets? Overweight or underweight? Underweight, all right? Some students miss that, but it's like, I just blatantly say, this asset class is going to do really poorly. What should you do? You probably want to underweight it, all right? And then alternatives, that's where I can give you 1, 2, 3 things. Who knows what's going to be But you can see I'll get somewhere between 17 and 19 things should be on your answer, all right? So that's really, really critical. Alternatives, there could be something on inflation, on diversification, something specific. Private equity, maybe it's hard to put private equity into this answer. All right, so right now you're kind of worried what does he mean? So why don't we practice them? All right, so what we're gonna do is gonna practice some answers. And then, yeah, we should be able to get to a couple of them today. I'll email out maybe this weekend the question from last semester. All right, we'll see. Maybe I'll do that next week because the exam's still a little bit of a ways away. And then we'll have someone in a class volunteer for me to grade their answer, and y'all watch me grade it, and you'll see, you know, how picky I am. I'm picky because that's how you get the jobs. You don't get jobs in finance by, yeah, I kind of like this. No, you get jobs in finance because you are specific on the details. And you know exactly what you're talking about. It is a very detailed, specific field. So I want you being very, very clear. This is not my pickiness. This is actually the way you need to answer these questions. So here's a question. Your boss has just provided you with the following forecast. Now, where did I get these forecasts? I usually steal them off the internet. So I go out and I find somebody, it can be Ken Fisher. I stole USA's one year. I used to write USA, so I went out and said, hey, I wonder what they're doing now. So I went and John Spearhead, he's out there. So I stole his and rewrote it, where they put it on the exam. You know, who knows? I'll find someone. I might steal Jeremy Grantham's, although probably not now. He's about as negative as you can be right now. But I'll steal somebody's. I'll have to reword it a little bit, but I'll steal somebody's idea. So don't think what you're getting on the exam is what I think. So, you know, I've got to give you a scenario, and I'll change it around. So who knows? I'm just picking a scenario. So I don't know where I got this one from, but I believe the recent good economic data is genuine. I expect surprises on the positive side. Now, these highlights you're not going to have on the exam. All right, you got to bring your own highlighter, whatever pen. Surprise on the positive side for the U.S. economy with higher economic growth. All right, so right now, what's the general mood on the economy? Very positive. So already, what can you say without even, of those 18 things, what can you already knock out? Stocks versus bonds, where are you over there? More stocks. What about high yield? Sounds pretty good. What about small cap versus large cap? No, strong economy. Small cap, right? What about value versus growth? Value, right? Values are weaker. They're kind of like high yield, they're weaker, so they do better in strong economies. You know, already you can already put down a good chunk of these. Inflation should remain well contained. Can you add another one to the list? What are you gonna do with tips? Underway. Why do you need tips if inflation is gonna be well contained? But interest rates should rise to more normal levels from today's very low levels. So what else do you know now? What are you gonna do on duration? Shorten duration, all right. Emerging countries should see very strong economic growth. All right, we got emerging markets. What are you going to do there? Overweight, pretty obvious. While developed countries, especially Europe, should continue to see very weak growth and even some mild recessions, the US dollar should strengthen. So on developed markets, you got two things there. What are you going to recommend? Overweight or underweight? Underweight and why? Weak economies, weak currencies, all right? You got those two things. We should expect some volatile periods as market. Now, some students get real, they see the word volatile and say, oh, okay, we want to be selling convexity. They didn't say volatile interest rates. So we don't know in this question, we don't know what they think about interest rates, volatility. So just because you see the word volatile, that doesn't tell you whether or not you should be buying or selling convexity. It's volatile interest rates, all right? Volatile stock markets have nothing to do with mortgage-backed securities. So it's interest rates. So they didn't tell you anything there. As markets react to news from Europe and some added diversification to control our portfolio risk. So that's where those alternatives come in, help provide some diversification. Yeah, you'd probably want to have, more commodities, more real estate. Corporate law changes will be important to watch, but let's assume do not change over the next few years. Continue to assume marginal tax rate of 30%, effective rate of 20. You don't care about the effective rate. This is a marginal decision. All you care about is the marginal rate. So just completely ignore that effective rate. That's just a red herring just to throw you off. All right. So what would you do? So you're going to move down in quality, more high yield, more intermediate, more medium quality bonds. You want to shorten duration. Prefer US, prefer emerging over developed. So I'll give you this list. They're not color coded. So the main bullets is what you get. And you write in between. And some of this I didn't write well enough, so I'm going to correct my own. This is kind of too high level. Boy, I hate this thing. So long US Treasury bonds. How many things there? 2 things, right? What do you think about the long-term nature of it? You like that or not? Don't like them, and why? Rates are going up. See how this, so students will say, avoid long-term treasuries. You have to give me the why. If you don't give me the why, you get no credit. So here's an exam where you can get every answer correct and you get no credit. I'm much more interested in the why than I am, because you can guess, oh, let me overweight them. So that's not what it is. I have students turn this thing in and it says underweight, overweight, underweight. If you don't tell me why, it's 0 credit. Even if you get every single one of them right. That's why I hate true false questions. If I did a true false exam, it'd be true or false and why. And you have to write in why. As 50-50 guess, I don't like the 50-50 guess. All right, so long-term treasuries, rates are rising. I want to shorten duration. This is really poorly worded. Weak need for high quality, but you don't need high quality, right? Because we're going to have a strong economy, so we don't have to move up in quality. So 2 things there, duration and quality. Strong economy with rising rates. We definitely want to shorten duration. We definitely don't need high quality, so we don't need US long treasury bonds. Medium quality, short-term municipals, the current yield of 0.2, 0.6. Medium quality, see how they're the same, medium quality, short-term corporates with the current yield of 2.9. You don't have to write anything under corporates. You can put your entire answer on municipals because the first 2 things under municipals are applied to both corporates and municipals. It's the fact that they're medium quality and they're short-term. They're both the same desk. So you're going to have the same answer on them on the medium quality and short-term. Doesn't matter if they're municipals or corporates. And then the last part is, once you make that decision, do you prefer the corporates or the municipals? And that you can put in municipals. So the medium quality, that sounds pretty good to me, right? We don't need high quality, medium quality. We're gonna get that extra spread. The world's gonna do well. Short term sounds good because rates are rising. So the only question is, do we prefer the municipals or the corporates? The tax effective yield is, you take the 0.026 divided by 1 minus 0.3, remember the marginal tax rate, that gives you 3.71. 3.71 is higher than 2.9, so you prefer the municipals over the corporates. You'll probably still buy some corporates, but if you normally have 10% of municipals, you might move up to 10, 15, 20% of municipals and maybe cut back to other places. But you see how there's 3 things there. This is probably one of the biggest misses for students. Stocks overall. Now, one thing I'll tell you, stocks overall is not on my list. I give you a list of every asset class but that one you just have to know. I would probably start with that one. I put it kind of in the middle, but I'd probably start with that one. Stocks overall, yeah, let's over allocate the stocks because you're expecting a strong economy. What about US large cap, low beta? All right, so I like stocks overall, and here's where you have to add a word. I don't have it in here. I like stocks overall, but within stocks, I have a preference for what? Smaller cap, have a preference for more cyclical, have a preference for value. So we have large cap, low beta. Do we really want large cap, low beta? You much rather have small cap, high beta, wouldn't you? So strong economy, good growth, don't need to be defensive. Low beta, don't need to be defensive. Small cap, high beta. Small cap tend to beat large cap, that's good. Strong economy, cyclical stocks look good. So two things. Now, if you say small cap tend to outperform large cap in strong economies, and you don't say that under large cap, I'll give you credit because you made it clear there. So I'm not that harsh on it. So it's pretty obvious. Small cap outperform large cap, that's a reason overweight small cap and is reason underweight large cap. You'll get 2 points there. Developed market, Europe's going to be weak. Dollar's going to be strong. Underweight. Emerging, it's going to be strong. Alternatives, you want some diversification, so overweight there. All right. Let's try another
It
one.
says, no,
What?
I don't know.
All right, let's try another one. Let's see if I can get this thing to work. All right, so I believe the looming fiscal cliff, this was in the year of the fiscal cliff. I don't know what year that was. But the fiscal cliff was, our Congress likes to spook the entire world and say, hey, we're not going to pay any of our debt off. We're going to cut 500 billion out of the federal budget, overnight. And they'd like to take it up to the 11th hour, don't they? It's like, we're going to ruin the entire world. And that's kind of our negotiating tactic. So Democrats and Republicans are playing chicken, and we're just watching, having fun watching. So that was what was going on this year, fiscal cliff. If Congress can't make a decision, they're going to cut billions, trillions out of the federal government, and it's just going to cause a major recession. The looming fiscal cliff in Europe, sovereign debt crisis is going to send the U.S. into a recession. So already you probably have 9 of the 18 things right there. All right. I don't know where you were 3 months ago. If someone said we expect a recession, you're like, yeah, you know exactly what to say, but hopefully now you feel more comfortable. So you get into an interview and they say, hey, we're expecting a recession. What would you do? Can you answer that question? So just off the top of your head, what are the things? So we said we have 18 things. How many can you get? Just based on that, the recession. Let me type some of these down. Well, don't do interest rates yet, though. I see what you're saying. That is correct. Give me the most obvious one. Where do you start with? Expecting a recession. Yeah. Bonds over stocks. And what about bonds? Higher quality. All right, there's one. What else can you say? So, so higher quality bonds. So what wouldn't be that? What would you avoid in the bond category? Yeah, avoid high yield. So in high yield, definitely. Anytime you see recession, you're down on high yield. Recession, underweight high yield. Pretty obvious. Don't go into an interview and say, oh, you're expecting a recession? Yeah, I think I'd buy some of those below investment grade bonds. That sounds like, no, they're probably not going to go much further in the interview. Yeah, so that's kind of obvious. What else? High quality. What would you be doing with the stock within the stocks? What else? There's 3 of them. Large cap, BUCS. What's the BCS? Yep. Defensive, right? Large cap, that's the C. What are we missing? You got the B, the C. What are you missing? Huh?
You should go US.
Well, we're not doing US, non-US yet because we don't know how bad the recession is US versus other places. So what is bucks? Ross just gave it to us. What is the bucks? Data, capitalization, style. We don't have style. What is style? You're expecting recession. Growth, right? So right there, you essentially have 1, 2, 3. You essentially have 5, 6, 7. Really, essentially have 7 things right there, or almost not quite. Over a third of them done just by knowing it's a recession. You got a third of them already down. With Japan following suit and Europe continue to be in recession, economic and corporate earnings growth will be well below historical levels. Are those expected by economists and stock analysts? That doesn't really tell us anything new because that's what we expect in a recession. However, emerging countries should see decent growth. Can we add anything to the list? Then stocks, emerging markets. That's a pretty easy one there. Just gave it to you. As their consumers begin to spend more and these countries open up to more trade with each other, that didn't really happen, so that didn't really work. Inflation should remain well contained. Can you add anything else? So we're up to what we got. 1, 2, 3, 4, 5, 6, 7, 8. We're up to 9. We know we need about 18, so we're over halfway there. I don't think I've even gotten halfway through the page yet. Inflation will contain and expect interest rates to stay in a tight range. Now this one's a little tricky. Tight range, what does that mean? Volatile, not volatile, rising, falling? Very low volatility and not moving much. All right, so that's kind of interesting. So this is tough on duration. Here's one where you have to have a little bit of knowledge of interest rates from your money and banking class. So what does the yield curve normally do? Is it upward sloping, flat, negative sloping? Upward sloping, which means the longer duration you go, what do you pick up? More return, more yield, right? So if interest rates are falling, longer duration is good. If interest rates are not changing, do you see, you can also make an argument for longer duration because the further out you go, the more rate return you're getting. So, but they're going to be less volatile. So you can see that longer duration is okay with flat rates and low vol. What does that imply that you can do? Low volatility of rates. DC cuts I, what's that first C? Convexity. So what are you going to do if interest rates are going to be low volatile? Overweight, convex security, sell convexity. All right. I think rates will be even less volatile than that currently priced in the bond market. With most of the developed world, the basing is currency. I think the US dollar will hold up well versus other currencies. It's hard to see up here what they think about developed versus US. I didn't quite give you enough information on that, but they do expect US dollar to hold up well. So what are you going to say on developed markets? Might avoid them, right? It's going to send the US into recession, and Japan and Europe are going to follow. Japan's going to follow into recession. Europe's already in a recession. It's hard to say which country is the worst here, other than knowing emerging markets are good. So I didn't quite give you enough information there. So we'll see. But we at least know avoid develop due to strong dollar. That we at least have. So we're getting in the ballpark here. As I'm not concerned about inflation, while many investors are, I'm not sure diversifying in real estate assets at this point makes sense, as these assets already appear to be priced at a premium. I mean, how much clearer can they be? What about real estate? What about commodities? What are they saying? Not really. If someone tells you, I'm not worried about inflation, which is the main reason to buy these assets, and I think they're materially overpriced, it's not too difficult to say, yeah, I don't think we want to be buying that asset. So that's one that's kind of just given. However, we should continue to seek other ways to increase our diversification. Maybe that's private equity. Who knows? Maybe it's gold. But we don't really need gold here in this case, right? Because inflation is not an issue and the US dollar is going to be strong. So you don't have a strong case for gold here. And tax law will be important to watch. I expect rates to increase. This is not interest rates. Right? I'll try to be clear on what rates are they talking about here? Tax rates, right? Don't see, I expect rates to increase. Oh, okay, I better shorten duration. Don't get confused there. Just because you see the word rates increase, don't assume that means interest rates are rising. Just because you see volatility, don't assume that means interest rate volatility. So marginal tax rates 40%. So here's our asset classes. Long-term treasuries. Here I say underweight. Why? Because I prefer the mortgage-backed securities. All right. But long-term's okay because rates are stable. So this one gets a little tricky because between mortgage backs and treasuries, I prefer mortgage backs because you get that higher yield and rates are going to be stable. You'll get to keep that higher yield. High quality bonds, expect a recession. So the high quality is good. Long-term, we expect rates to be stable. So long-term is good because longer term there's high yield. And then we make the adjustment. And 633 is a lot better than 4.9. Mortgage backs, we want to sell convexity. Make sure you put this in your answer. Why do you want to sell convexity? Because you get that higher starting yield. That's really critical. Remember I said if the yield's the same between mortgage backs and treasuries, you would never buy the mortgage backs. It doesn't make any sense. They're both 5%. You buy the treasuries, you're going to get 5%. You buy the mortgages, you're not going to get any better than the treasury because you could get a lot worse. So if the yields are the same, never buy the mortgage backs. But if the yields are higher on mortgage back and you think rates are going to be stable, then that's a good reason to buy mortgage backs. You get to capture that higher starting yield. Stocks overall, underweight stocks due to recession, overweight high quality bonds, US large cap. This is an important term right here in your answer, within stocks, because we might actually underweight large cap, low beta stocks overall, but within stocks, they're going to be higher weight. So we're going to reduce our stock allocation, and that might reduce large cap, small cap, mid cap, but we won't reduce large cap as much as we reduce small cap. So within stocks, we're going to have a tilt toward large cap, low beta. Yeah, here, I don't recommend you do this. See one bullet there. What should you do here? Make sure you have 2 bullets. All right. Overweight within stocks because large cap do better in recession. Overweight low beta stocks because low beta would do better in recession. Make it 2 bullets. US small caps. This is only one thing here. Underweight. They underperform large cap in a recession. Underweight because of slow economic growth. US dollar is going to be better, emerging, overweight. And then I gave you private equity. If you want some diversification, I'm not sure I'll buy that argument, but it is true that private equity doesn't look as volatile as other assets because they're not really priced every day. When I did private equity, I would get a book once a quarter with an estimate of what everything was worth in the portfolio, written by someone who wanted really high numbers. So I was getting an estimate from someone who had a really horrible bias, and so who knew if those numbers were reliable or not. All right, let's see how many. I'll let you read this one and you write down. Let's see how many you can get. We'll have a competition. $10,000 to whoever does it best, unless I change my mind later.
Take that.
All right, so your boss has just provided with the following forecast. This is a pretty recent one. We need to position our portfolio for the remainder of 2020. Boy, I don't know when I wrote this. Is COVID in there? Yeah, COVID's in there. All right, so I wrote this after COVID. I don't know when we would have taken the exam. I mean, I went out on spring break and never came back. So it would have been like March 15th. So it probably was before the first exam. I don't know. It was kind of strange, right? So anyway, I think we knew about COVID. We'll see. I believe the economic fallout from COVID-19 will be much worse than expected in the markets right now. Many are assuming there will be a rapid recovery in late summer, early fall, but I believe the economic downturn will be much deeper and last much longer. So obviously I got that wrong. If that was my forecast, I don't know who this is. Corporate earnings will fall and stay down for 4 or more quarters as the so-called pent-up demand from consumers never materializes. Consumers will be wary of spending even if COVID-19 cases drop off, given fears about a second wave in the fall. I got that one right. Europe and Japan will probably do better than the US as they are much further along in handling COVID-19 and their economies should come out stronger and earlier than the US. US dollar will weaken in this environment as interest rates in the US continue to fall to historically low levels. Got that right. Rates will then stay very low and show little volatility as the Federal Reserve signals that they will keep rates low for an extended period of time. Developing emerging market countries will fare the worst of all as their healthcare systems will be inadequate to address COVID-19 and the trade of the US will be weak for some time. Spreads on corporate and municipal bonds should widen dramatically, especially for the lowest quality bonds. Corporate balance sheets are highly levered after years of firms buying back stock and issuing debt, and municipals are facing huge budget crises in trying to respond to COVID-19. Our marginal tax rate is 25%, and our effective tax rate is 30%. So you need 18 things, 17 things on your list. And you want to get all 17 of those. It's not 17, but I'm going to be 16. I gave you the answer in one place, so I'll take that back up. Here's the list of the asset classes.
So on our test, you'll provide us with this, or
Yeah, this is exactly the test question. I give you that, and I give you that. So what's the one thing missing on the list that you got to talk about? Stocks versus bonds. Yeah, that's the only thing I'll give you. Other than that, you just go through this list. Y'all, let's see if y'all remember, how many bullets should be under long-term treasury bonds? 2. How many under tips? Just 1. How many are mortgage backs? Just 1. On a municipal bonds and corporates? 3. Yeah. High yield? Just 1. Large cap, low beta? 2. Small cap value? 2. Developed? 2. What are you forgetting? Don't forget currencies, right? Emerging? 1, and then alternatives would kind of depend. All right, so you're kind of seeing that. So if you write 2 bullets under treasuries, you may forget how to answer, but at least you know you got to do 2 things. Then you have a better chance of not leaving something out. All right, anybody want to give it a shot? And we got 15, 16 of them. Takers. Do what scares you, remember? Jump out, take a risk. Any takers? Someone's sitting there going, I think I know this, but I'm just too scared to try it. Anybody want to just do long-term treasury bonds? What are you going to do in this environment? Overweight, underweight. Overweight. What are the 2 reasons? What do you like about long-term treasuries? What 2 things do you like about long-term treasuries? First of all, they're high quality, and secondly, high convexity. High convexity, but in this case, what do we say about convexity? Rates should stay very low, low volatility. So does that make you like treasuries or prefer mortgage backs? Yeah, so you're actually gonna prefer mortgage backs, but you're gonna put that under the mortgage backs. So it's high quality. What else is it? Long term. What did they say about interest rates? Interest rates in the US will continue to fall historically low levels. Boy, I got that right because we hit an all-time low on the treasuries. I don't know if this, again, I don't know if it's my forecast. So you like the long term. You like the fact that there's treasuries. You might under here say, however, overall, I prefer mortgage backs over treasuries. I like treasuries, they're good, but I'm probably gonna put some extra in the mortgage backs. Because mortgage backs are also high quality, but they also have that wonderful negative convexity when rates are not volatile. Tips, what do we say about tips? We didn't say anything about inflation. What does this scenario imply about inflation? Does this sound like a high inflationary environment at all? Doesn't sound like it. So I would say, you know what, I'm just going to avoid tips because I don't see anything here that makes me worry about inflation. So now the US dollar weakened. Someone mentioned, US dollar weakening. If your currency weakens, that is inflationary because it makes imports more expensive. But in a weak economy like that, imports are probably not going to get much out of it because there's no one here to buy their stuff. So mortgage backs, what did you say there? Overweight, right? You want to sell convexity, pick up that higher yield. All right, so medium quality, what's your view there? What do you prefer over medium quality? Is it too high quality or too low quality? Medium quality, we're talking like triple Bs. You're a little nervous, right? In a weak economy. I might want to avoid that. What about intermediate term? I might prefer a little bit longer term, right? Rates are falling. So, if you want to make an argument, well, I definitely like medium quality better than high yield, but I think I would go to high quality. That's a pretty stark forecast. I don't think medium quality is what I want. Triple B don't do that well in a really bad economy. So I think I'd avoid them. High yield, easy one, right? What are you gonna do in high yield? Is this a high yield environment? No, you avoid those. Stocks overall, underweight. Large cap, low beta. What's the two words you start with? Within stocks, what are you gonna do? Do you like these or hate these? Those are good. Now, I realized in 2020, well, I don't know, I guess low beta, you're talking grocery stores, they probably did do pretty well last year. And high beta like Carnival Cruise and Delta Airlines didn't do very well, so it probably did work. Small cap and value, what do we say about value stocks? Are they high quality or low quality? Low quality, you don't want those, and small cap are not going to do well. Now, small cap in 2020, my word, the government was like, here's another $1 billion, someone come take it, please. And there were some small companies that it was just ridiculous. Our government was bailing out. We were bailing out a lot of people who didn't need money. So some of them might have done okay. Developed markets, what did we see there? That one was just given to us, wasn't it? Europe and Japan will probably do better than the US. Now, I didn't say developed markets, but Europe and Japan is, 70%, 60% developed markets do better, and the US dollar is going to weaken. What does that tell you? Developed markets, overweight for both reasons. Emerging, underweight. Yeah, they're going to do horribly. And alternatives, they said they wanted some diversification, so maybe you do something like that. All right, so we'll do a little bit more of this on Monday and give you a little more practice. Y'all see the exam now. You got your entire exam. Anyone's going to volunteer to do exam question 1 for us next week? Email me if you are. You don't have to put your name on it. You can get your exam 1 question graded for the rest of the class, and then you can even edit it afterwards.